Thanks, Michael. I didn't mean to drive the panel away or scare them away. So I have a few observations I'll make. It may appear disjointed, and that's probably why I do what I do now. But event, I've been kind of close to the Fed for a long time. Back in Reagan's era, the New York Times said I was in the final four candidates to be vice chairman under Volcker. That would have been fun. And I've had a few narrow misses since then, but nonetheless, I've been an outsider, and I can say things now that probably will hopefully not offend my colleagues, but we'll see what happens anyway. So Janet once said that the Fed was not politics didn't mix into their decision making at the FOMC. And I guess my view has always been, well, it's a Johnny One Note Fed. Now, most people don't know what that means anymore. That means I'm old. Johnny One Note was a famous song for the big bands in the 40s, about a guy with a trumpet who could only play one note. And my thought was, well, if you've got a board of governors that's all appointed by one president, you don't have to have a political discussion because they're all on the same page already philosophically. So it doesn't really matter, right? So you can ponder that and see what you think about it. And I have fun, too, with the observation that the Fed has achieved its mandate. Who defined its mandate? Technically, I mean, who picked 2%, for example? And of course, we have the unemployment rate issue, and we have a low unemployment rate, but we also have other measures of participation rates, et cetera, that we're not happy with. In 2000, we employed 64.5% of the adult population, and now we're down to around 60. We know part of that reason is old people like me retired, but so it's kind of fun to have a mandate that you can kind of define what it is and then pursue it. I'm being a little mean here, but all right, he's nodding. All right, so anyway, so I'm really happy that we're going to get some diversity of views in the policy making. I'm going to take my collar down a little bit, but what I hope is not included in that are tweets. I don't want to see the president telling us where he thinks interest rates ought to go and who ought to face the death sentence. You don't like that. So my job since I quit grading papers has been basically the chief economist for the National Federation of Independent Business. We have 325,000 members around the country. And back in 1973, I started working with an NFIB when I was teaching at Stanford. We designed a questionnaire to ask a bunch of informational kind of things, and we've kept this questionnaire pretty much the same all that time. And I still am doing the survey, so it's kind of a fun deal. But we get a lot of perspective on what's going on. Why is small business important to the economy? Well, if you believe the SBA, it's half of private GDP, half of private employment, and 2/3 of the jobs created. Those are consistent just because we fail a lot, so you can have 2/3 of the new jobs and still only 50% of the employment, right? Because it's the R&D sector for the U.S. economy. That's why we do those kinds of things. So in 1982, we started a series of surveys called Most Important Problems. So every 4 years, we send out a list of 75 business issues and ask a random sample of our members to rank them from worst to least worst. There's no good things on there, right? They're all bad things. And in 1982, the first survey, guess who was at the top of the list? The Fed. Volcker, tight credit, high interest rates, that was the number one concern. 4 years later, the number one concern was the cost of health care insurance. And it's been there ever since. So once the Fed made it to the top of the list, but since then, credit has really not been an issue, and it hasn't even broken into the top 20 since that time. The biggest vote getter ever since 1973 is inflation, and then, of course, the Volcker time. Credit was number 2, and both of those occurred, before 1985, say, or 84, somewhere in there. And so since then, credit really hasn't been an issue. So if you look at our most recent survey, which we just finished in October, 2% said inflation is their top business problem out of a choice of 10 things, and 2% said credit availability and cost is their top business problem. So it's been there. Only 4% of our owners say, I didn't get all the credit I deserved. What's worrisome is 53% said, who wants a loan? I don't want one. I'm not interested in one. And that's about 15 points higher than it was prior to 2007. So starting with the Great Recession in 2008, that jumped up about 10 or 15 points and stayed there. So as a banker, and I'm the chairman of the board of a little 3-branch bank who lends to small business, we're waiting for those people to come back into the market and borrow the money and spend it, capital spending, CapEx, and all these kinds of things. And it just really hasn't been happening. So back to that list of 75. So if you look at the top 10, number 1 is healthcare. Number 2 is the cost of complying with government regulations and red tape. Okay, that's number 2. Number 3 is the tax code. And also 4, 5, 6, 7, it's not just the tax code, it's complexity, it's frequent changes, it takes my capital that I invest in my firm, so my profits go away. Then, of course, state taxes are on the list there. And basically, that's the rest of the top 10, except for uncertainty about the economy and government policy. That's in the top 10. And for the first time since we started the survey back in '82, a real business problem has made it into the top 10. Finding qualified workers has finally made it into the top 10. So that's the kind of situation we have now. In fact, if you look at our most recent survey, a record 31% of our owners say they have job openings they can't fill. If you look at construction firms and if you look at manufacturing firms, that goes up to 40, 50, 60% who say, you know, I can't fill the job openings that I have. We also did a fun study about, well, what makes people unqualified? Remember, these aren't tech firms. These are little small businesses, right? So what makes all these people, why can't they fill these positions? They don't require a lot of human capital. So we did find out that about 35% said a typical problem was that you didn't have the right skill. You can't be an auto mechanic if you haven't learned how to drive. All right, so that would be one. And then a poor job performance, that was about 20%. But then 15 to 20% are appearance, attitude, unreasonable wage expectations, lack of social skills, all kinds of stuff that have no relationship to per se to the skill set that the individual has, but rather these are things they could cure, you know, take a bath, take the earrings out or whatever it is so that, you know, you can fit in. But those are the typical reasons for people being disqualified for all these openings that we have. I thought that was kind of an interesting look. But banks are really important for small business. About 90% of all businesses, small businesses, rely on banks for capital of various kinds, operating capital, long-term investment capital. Once they're established, you have to get established first. Banks are not venture capitalists. So you see complaints about, I want to start a firm and the bank won't talk to me. Of course not. The bank, if Bill Gates had gone into my loan committee and said, this is what I want to do, they would never have granted him a loan because they had no idea what he was talking about. So we don't do venture capital. We do, kind of ordinary lending, and that's fine. That's our job, and somebody else can do the venture capital. But my loan committee today is uncomfortable about making 10-year loans at 4.5% and 5% because they remember not too long ago we paid that much to depositors, and now we're making loans even with a 5-year reset. That's really worrisome. So they think there is a normalization that's going to happen and rates are going to go higher. So they're really uncomfortable about that. But we'll see. I don't have to worry about that much longer, by the way, because I sold the bank. I say I sold the bank. I own that much, and I'm chairman of the board, so I'll refer to it as my bank. I was involved in starting the bank, so I can be there. But I'm in favor, of course, of consolidation that's driven by economics, technology, and so on, but I am very much unhappy about the consolidation that's occurring among small banks because of the regulatory costs. And I can tell you, I've been the chairman of the board for 11 years when we started. That's our big cost issue, is regulatory compliance. And that's a shame that we're losing these small banks in the communities that are really integrated in their communities because of the regulatory costs that I think are, as I look at them, are pretty much useless for the small banks that are out there. But they're very important to the communities, and we're going to lose them. One observation about the shape of the banks. We've been studying banking relationships now since the early 1970s. Everybody should remember, or most people will remember, that we once had branch banking rules, right? So we had states that said you can only have one branch, that's it. And then we had states that allowed limited branching, and then we had states like California back in the day that allowed statewide branching. So we studied the terms of the loans and so on that we would get from firms in these various kinds of regulatory structures, and found out that you got the best terms and the most happiness with the banking relationship in unit banking states. And then it just went downhill from there to statewide branching. Of course, now we have worldwide branching, so it's all out of the question. So a few other interesting quick issues. Is the Fed targeting asset prices? Are they? Is it? They said no. But there was, this whole discussion amongst Fed people about, well, if asset prices go up, then people feel richer and they spend more money, and that will stimulate the economy. And that hasn't really happened, we don't think. But but I do kind of look at that issue just for fun and look at the Fed numbers on our net worth. The Fed says our net worth is about $90 trillion. That's a big number. That's after we subtract out the $14 trillion, which is all the debt that we owe, the mortgages, et cetera, et cetera, et cetera. And I look at net worth as just a store of purchasing power. So you can sell your Apple shares, and if you have enough of them, you can buy a Mercedes, otherwise you get a VW, but it's a store of purchasing power, right? And that's what it's all for. You want stuff, and that's what your net worth allows you to have. So I said, okay, well, let's look at that, and let's look at the ratio of net worth, claims on output, to output we produce, GDP. All right, that's our rough measure. Well, for about 3 decades, I didn't go back further, that ratio was always $3.50, more or less, a little waving around the line, $3.50. For every dollar GDP, we had $3.50. Then there was the dot-com bubble, a little bubble, but of course we were disabused of that notion. You can't retire on catfood.com, so that didn't work. Then there was the housing bubble, and then we were disabused of that notion. You can't retire on your housing value, although now we may change our mind again with the way house prices are going. But anyway, then there's where we are now. We're at about $650 now, much higher than we were in the housing bubble. So I worry about that because that's, every time we've gotten a bubble like that, we've been disabused of the fact that we're rich. So I don't really believe that our net worth is that high. Certainly it's not that high in terms of the claims on stuff you can make with the net worth that we allegedly have. So we'll see how that all, leads me to think we're going to have a major adjustment in markets again. We'll see if I'm right or not, but whatever. Let's see what a few other things I had here. About inflation, asset prices, I did that. By the way, if I were the Fed, I would have been popping champagne at every meeting, celebrating how low inflation has been. It worries me that I have a central bank that's committed to creating inflation, 2, thinks that they can control it once it starts, other than the way Paul Volcker did, which was painful. Anyway, so I worry a little bit about that, and I do agree with the comments about the Fed hoarding assets. There are $4.5 trillion of safe assets there, risk-free assets, guaranteed mortgages and treasuries. There's a shortage of those out there. A lot of it's because of the regulatory stuff. We all have to hold more of that stuff with the bank regulations coming out. And of course, everybody else wants it. And of course, what we've done is with this whole thing about QE and getting interest rates down, what we've done is to saddle the private sector with tons of low-yielding securities, which firms are having trouble with now because they don't know how they'll pay their commitments on retirement benefits, et cetera, et cetera, et cetera. You can't do it with 1.5% treasuries, 10-year treasuries, or 2% treasuries. So I think there's a distortion from QE. The Fed was accused of printing money. Well, they didn't print money. All they did was liquefy us. They went to you and said, I'll give you $1,050 or $100, $1,100 for a bond, that you have in your portfolio, and we'll take it. All they did was liquefy you. You weren't any richer. And then you took the liquidity and said, let me find another bond that yields 5% or whichever one you sold, and you can't find them, of course, because there's all the demand for the bonds has built the price back up. So if you look at the current bubble, the main thing in the current bubble that we didn't have before is bond prices. When interest rates are at record low levels, bond prices are at record high levels. And if we're going to raise interest rates, if that's normalization, whatever that is, you can see what's in store for us. So I worry about where all that's going to go and see what happens. Let's see about, there was a, I can't tell you what Chris was going to say about lower real interest rates, but he's got some slides. Maybe we'll share those with you later if you want to get a copy of them. But, I always thought about the interest rate as a proxy for the return on capital. So in simple terms, if a firm can't pay more for capital, whether it's an interest rate or a dividend, but the return on capital, a firm can't pay more for the capital than they earn with it, right? Or they go out of business. And if you look at interest rates over the business cycle, they always fall when the economy is weak. So I don't know. I just think we now have, you don't get inflation unless demand pushes up against capacity. And except for new houses, where I think we are short on capacity side, and I gave you some stats that confirm that, and so did the panel. You don't have demand pushing up against capacity. It's global capacity. There's lots of capital deployed out there. We can make all the steel you want, all the cars you want. There are very few things that are hard to think of in terms of, we're going to have inflation pressures, which is fine, but it does say that the low interest rate tells you something about the return on capital when there's lots of it in terms of the ability to produce stuff that you and I want to buy. So we'll have to think about where that's at. Now, the Fed spends a lot of time on models, and I will just make the observation that sometimes I think the view of our Fed people is that, the model doesn't square with what we're observing. What's wrong with the world? Rather than, is my model really the right model of what's going on? And I'd like to see a little bit less of that, I guess, going on there. But if the Fed thinks that that interest rates are as low as this way they are now naturally, sell back the $4 trillion and see what the return on the 10-year treasury is once they do it, okay? So, all that said, just a few provocative comments. The small business sector is happy, and I'm going to report on that tomorrow. Optimism went up in October, so don't tell anybody because we don't release it for another week, all right? But so we're still looking very good, and that's half the economy. They are confident that things are going to get better. They obviously are not happy with what's going on in Washington. Who is? And still they're optimistic. So I think this is their view now, kind of a psychology thing. What they know that we're going to get tax changes, and they know we're going to get health care changes. And their view is just this: whatever we get, it'll be better than what we've got. And so therefore, good things are in our future. It could be really good if we get really good legislation, or just somewhat better, but there are better things coming. So I think they kind of take that view. And of course, it's good to have positive expectations about the future because investment is all about the future. And so all the decisions these little people are making out there is about the future. And it's great to see them so confident. It was fun to track. The long run average for our index is 98. In October, the value of the index was 98 last year. In the first day, in the days before the announcement of the election results, it was also 98. In the last days of November, 102. And then in December, it went to 105. And it basically hasn't changed it's down to 103, 104 now. That's basically been there ever since. So they really like the management change that they saw, even though it's very confusing. It's a change from where they were. They like it, and hopefully they will continue to hire and spend and do the kinds of things we need them to do to keep the economy moving forward. And I probably should quit there.
Questions
Sure.
from the audience, keeping in mind that we're between them and lunch.
Yep. That's why I tried to make it fast.
Are there any questions?
Got one here. Wait a second. When do we get the microphone?
The survey that you just quoted, when folks went from being at 98, say in terms of optimism about things, from 98 in early October of last year to about, call it 103 now, who's being surveyed specifically? Who's being surveyed in that sentiment index?
I'm still not sure I got all of it.
So you just cited a survey where folks went from about 98 in October 2016 to about 103 now. Who are you surveying?
Well, NFIB has 325,000 members. About 15% are construction firms, 10% are manufacturing, about 35% are retailers. So we're kind of everywhere. About 20% non-professional services, 10% professional services. We got everybody, kind of. I mean, it's not a perfect representation of, not that we know what that is, what the small business sector really looks like. So I never say that this represents what small businesses think, but I do kind of feel that whatever's happening in the economy, whether it's the Fed changing interest rates or the tax laws changing, it impacts our 325,000 members the same way as the ones who aren't members of NFIB. There are about 6 million employers out there, employer firms, and then Lord knows how many non-employer firms, depending on how you view the Schedule C, 20 to 25 million more of those people. And of course, all of us are interested in what's going to happen with tax reform. NFIB did come out in opposition to the first proposed bill. And it's basically because we're worried about how pass-through organizations get treated. So we have to see what happens on that. But there are a lot of other things about the tax bill we like if they happen to occur. We'll think that they're good. But the pass-through thing will be a big issue for NFIB.
Do we have any other questions?
All right. Well, thanks for letting me fill in.
Well,
there's
last
a
question.
All right, last question.
One of the things that I think about a lot is we're probably towards the end of the business cycle, not any forecast, but just the duration of this particular cycle has already been pretty long. So if the Federal Reserve starts to increase interest rates like they have a little bit and say they're going to continue to do, will this push us into slower growth that will then prevent the Fed from raising rates further and in fact maybe have to drop them back to where they started?
Yeah, that's a good question. I'm sure our Fed colleagues worry about that all the time. My thought is really that if we're much better off if markets set interest rates than if the Fed does. And now the Fed says they don't do it, but anyway, we can argue about that. In our data, we do ask our members, last time you got a loan, was the interest rate you paid higher or lower than the time before? And the volatility in that is amazing. It goes from like plus 40 who say higher, a net of those who said lower, down to like a minus 30. I mean, a lot of volatility for decades. And then in 2009, it's straight lines. Because markets aren't setting interest rates anymore, not allocating capital, not being used for decision making. So I think that, I don't know what the normal rates are, but I think the market should be deciding that. Not government managers of what the rate would be. And if we let the market do the job, I think we'll do a lot better. Now, just looking at my little loan committee, they'll be more willing to make loans at a higher interest rate than when they're operating near the lower bound from their point of view, which is what we have to pay depositors. So today we lend at 4 and we pay depositors 40 basis points, and trillions of interest income have been lost since 2009. If you assumed we could have kept 2009 interest rates, trillions have been lost in interest income. Just look at the tax return data and you can see it there. So I think that the Fed raising rates, normalizing, will not stop very much investment. We say, oh, well, higher interest rates, people won't borrow. Well, I think they will, because the important part is not just the denominator of the valuation equation, but the numerator. So the Fed's in the denominator, interest rates. In the numerator is the cash flow you expect, the value you expect to get from buying your new car or starting your new business or whatever. And I think that will keep us going even with higher interest rates. Thanks.
Thank you very much.